Said we're going to go all in on AI, and that's what investors are really taking out of that.
I sincerely believe there is no bubble in the AI space.
China and the United States both stand to gain from cooperation and lose from confrontation.
We are in the midst of a rupture, not a transition.
Please welcome to the stage Bloomberg's Eric Schatzker.
Good morning, everyone, and a very warm welcome to Bloomberg Invest. I'm Eric Schatzker. I'm delighted to be with you today. Even more thrilled to be back here in Hong Kong. It was almost exactly a year ago today that I stood before you here on this very stage. So much has changed since then, as we all know, and before I talk about what has changed, let me talk about this. Because if I didn't talk about this, you might sit there all day long wondering to yourself, what on earth did Eric do to his finger instead of paying attention to what actually matters? This is the result of a fishing injury that required some emergency surgery in India a couple of days ago. And if emergency surgery in India doesn't sound like an appealing prospect to you, you're right, it's not. What can I say? It may be unsightly but it's useful. I can use this blob on the end of my finger as a pointer, so don't misbehave, say by not silencing the ringer on your phone, or I might have to call you out. I can use it as a conductor's baton to keep everything working in harmony and on time in case my colleague Katie there loses control of the program, which is very unlikely to happen. Or if here, when I'm on stage later, my panelists prove to be uncooperative, I can use it as a pendulum and hypnotize them to make sure that they answer my questions exactly as they should. So let's get on with the program. Let me talk about all the things that have changed in the past year: geopolitics, policy shifts, technological disruption, economic uncertainty. They all continue to reshape the market landscape. The result, of course, is a much more complex environment for investors. Things move faster, risks emerge more suddenly and unpredictably, and the ability to adapt matters more than ever. Amid all that change, however, one constant remains, and that is Hong Kong's enduring importance as a global financial center. I'm sure it's well known here, but if you didn't happen to know, Hong Kong has just replaced Switzerland as the world's largest cross-border financial hub. Before we move on, I'd like to make a couple of important acknowledgments. The first is to our presenting sponsor, eFund. And the second is to our supporting sponsor, Deutsche Bank Wealth Management. I could sit here and talk to you for hours about my finger, but I'm not going to bother with that. It's really important that you enjoy, that you experience, and that you learn something from what you're about to hear today and see take place on the stage. Let's move on.
Please welcome to the stage Paul Chan, Financial Secretary of the Hong Kong Special Administrative Region of the People's Republic of China, for a conversation with Bloomberg's Yvonne Man.
Hi, everyone. Thank you so much for joining us. I know it's a packed room here today, and I want to thank, of course, Secretary Chan for kicking off Bloomberg Invest for us here in Hong Kong. I think that sizzle reel just now just showed it all of the buzz that we're feeling here in Hong Kong. And I want to add to that buzz, Secretary, and show a chart. This is what we do in Bloomberg, right? And the China show. Look at the Hong Kong GDP numbers that we got in the first quarter here. We were talking about something that's punching close to 6% for the first quarter. Yep. Really being fueled by AI, the boom that we're seeing when it comes to exports and imports. There's a little bit of a recovery in the property market. IPO market continues to be strong here after we talked about reclaiming the top #1 spot for IPO market last year. And as Eric just mentioned, we just surpassed Switzerland when it comes to being an offshore wealth hub. So I'm going to use my unbandaged hand and finger to put my finger in the wind, Secretary Chan, about a pulse check of where we are.
Always up, right?
Always up. Hopefully. Does that mean there's more upside than downside risks to the economy? Where do you think this growth momentum can continue?
Well, the momentum continues to be quite strong. Take the IPO market, for example. The number of companies queuing up for listing, over 400 major companies. And we are also exploring with other markets like Korea, the Middle East, ASEAN, to have more dual listing. Not just stocks, but perhaps to begin with, things like ETFs. So the stock market, we remain confident. Asset wealth management momentum also very strong. Capital flow coming in. Last year, capital inflow into our various funds total over 400 billion US. So it is quite a significant increase compared to the year before. At the same time, we are very committed in terms of developing our technology and innovation sector, which will be one of our key future economic growth engine. So multi-pronged approach.
multi-pronged approach. The last time we spoke, Secretary, was back in March. I think it was just weeks, maybe days after the Iran war broke out. And you said it takes a few months to really assess what the inflation dynamics and growth dynamics will be. We're 3 months in now. I have to get your update here on how you're viewing the macro risks right now.
Well, over the past few months, as you may have observed, although the fuel costs went up, but overall,
one of the most expensive in the world in Hong Kong, I have to say.
Well, we don't encourage,
prices of the pump.
We don't encourage people to drive fuel-driven car. Yeah, use EVs, please.
Yeah. But does it mean that there's more? How do you balance the risks right now? Do you think that there is more upside or downside risk to your growth forecast? I think it's still around 2 to 3% right now for growth this year.
Well, the inflationary pressure will be building up. At the beginning of this year, we put 1.3% of the inflation rate projected for 2026. A few months ago, we revised it upward to about 2. So it may be well over 2, but still manageable. Because, say, for example, for energy supply, the majority of the energy supply is across the border, and most of them are renewables. So the impact on us, yes, particularly for those sectors like transport, they are affected, of course. But at the same time, the government responds very fast. We roll out support measures to relieve some of the pressures on them.
We talk about just this, even if we see the war end today, that inflation might stay here for a little bit longer, given just the damage to energy infrastructure, how long it takes for energy flows to resume the Strait of Hormuz.
And also the disruption to the supply chain.
Yes. Markets are shifting their forecasts, or at least what central banks can do. We've seen some central banks in this part of the world already raise rates. Traders are pricing in a Fed rate hike by year end. Can Hong Kong withstand a tightening cycle?
Our dollar is pegged to the US dollar. So in a way, we are affected by the interest rate trend. Our assessment for the rest of this year is that interest rate in the US, given the inflation, very difficult to come down. But at the same time, although the trend is the same, but it's not on a lockstep. When you look back a few years ago when the interest rate in the US went up or came down, largely the trend is the same, but we judge the impact on Hong Kong based on our liquidity positions. Say, for example, if the capital inflow remains very strong, the interbank liquidity is high, so there is no reason for us to push up the interest rate. So remain vigilant, but at the moment, I think wouldn't be any very significant changes. Yeah.
I have to get your take on the regulatory environment right now. I think last time we spoke, Hong Kong in some ways is a victim of its own success amidst its IPO boom. We were talking about the priority is quality listings. The last couple of weeks, we've seen what looks to be a pretty unprecedented crackdown from China on cross-border trading. What we heard is that it started in the brokerages, but there's lingering concerns in the market now that this could spread to financial services here in Hong Kong, whether it's wealth, IPOs, property. What are you hearing on the ground?
Number one, the central authorities are very supportive of Hong Kong. They want Hong Kong to succeed as an international financial center, so no doubt about it. This is one. Number two, the recent crackdown are mainly on those people who move their funds to Hong Kong for different investments, not through legitimate means. So if the capital inflow are in the proper channel, they still are encouraged. We are still working with the central authority, for example, on further improving the cross-border GBA management, wealth management connect, to expand the quota of investment by individuals in the GBA area and diversify a little bit as to the products that they can invest. So that is just number one. But from a broader perspective, you know, we have the different connect schemes with the mainland. Stock Connect, Bond Connect. And on that, we are also building an infrastructure, a custodian infrastructure, ICSD. It is International Central Securities Depository Infrastructure, to enable different securities, bonds, equities, to be put in the same platform, to enable cost collateralization, so that liquidity could be quickly enhanced. And at the same time, on the basis of these collaterals, you can roll out different derivative products. So that is also one way to enhance capital efficiency. But from a broader perspective, even for the stock market, we are reviewing our listing regime to make it move with times, make it easier for companies of the future, say, for example, high-tech companies, to be easier to list on our stock exchange. We are also working to expand, to lower the transaction costs, to improve the settlement cycle, so it is on multiple fund, to enhance the competitiveness of our listing regime.
We've seen some reports of banks maybe taking precautionary measures, whether, you know, there's one Hong Kong bank that, you know, in one of their branches in Shanghai, that they suspended opening new accounts for mainland clients. We've heard some Chinese banks here in Hong Kong that have also suspended some of these offshore accounts as well for investment. We've heard banks here, and the UBS, for example, has postponed a wealth event in China. HSBC has talked to their Hong Kong-based private bankers, saying, you know, discouraging them from traveling to the mainland for now. What is the message to banks right now? Because, you know, is this an actual directive from Beijing, or are banks right now just being more precautionary?
Well, different banks have different practices, but I guess for the banks, the mainland market is growing in affluence, growing in their aspirations to have certain asset allocate offshore. But this must be through proper means. Say, for example, insurance products. The insurance products in Hong Kong, nowadays insurance is not just for life insurance or medical, but a lot of them are investment linked. So previously we have observed substantial capital flow coming to Hong Kong, investing in insurance products, most welcome, of course. But at the same time, some of them may not through the proper means. Now it is just put it back to the proper channel, but the products here remain very competitive, very attractive. And we are also working with the mainland authority about the possibility for our operators to set up an organization, not for selling, but for client services. So this matter has been receiving attention, and I do think when we put this into the proper channel, we can inspire the confidence of the mainland authorities about the unwarranted leakage of foreign exchange reserve. Then with that trust, we can move forward.
Do you think
on a
it'll
more
have
sustainable basis.
Will it have any long-standing impact on flows? Does it redirect these measures here, redirect flows back domestically to the mainland?
But I think the interest and the desire to have asset allocate offshore will remain. And this will continue to be a very, very strong driver for our financial services sector.
Yes, it's interesting. The long-standing practice has been, though, if you're a wealth manager in Hong Kong, is that, you know, these Hong Kong-based private wealth managers will go to the mainland, they'll meet and build relationships with clients there, and then they come here to Hong Kong to open an account, to buy an investment product. Will Beijing still allow that to happen?
Well, I think we have to step back a little bit. look at the bigger picture. Yes, in terms of cost boundary asset and wealth management sector, we overtook Switzerland.
Yeah.
And when you zoom in, about 56% of the AUM, the capital flow,
Comes from China.
no,
No.
it is come from outside of China and
Okay.
Hong Kong.
Okay.
And we are seeing increasing flows from the Middle East and ASEAN as well. So let's focus on building a bigger pie and improving the connectivity, which also, in a way, will help the sectors to develop.
Could it curb spending when it comes to the property market as well? I mean, the first quarter of this year, I think mainland buyers were sweeping up a lot of property here in Hong Kong.
Well, compared to the peak, still very moderate. The situation is also different. A couple of years ago, in the year 2008, until 2017, there is shortage in supply, shortage in land supply, shortage in residential property supply, coupled with the buying power from the mainland, went up property price, and we introduced different demand-side measures to suppress foreign demand and investment demand. But now the situation is different. We have enough land supply on the market as well as in the pipeline. As you may have observed from the land sale program we announced after the budget. Actually, that land sale program, the message are two. The first, to our people, we have enough land bank. So when the property market goes crazy, we will timely roll out additional land supply. So don't worry. But at the same time, the message is also to the developers. We have been very prudent and very careful in terms of property price and land supply. As you may have observed, say for example, in the land sale program, the number of lands sold by us, the number of units to be built on those lands in the past few years, not exceedingly large. When we roll out the land sale program, we also took into consideration, number one, the residential development undertaken by the MTR Corporation, the railway plus property. Number two, lease modifications, meaning that land initially, not for residential purposes, now being rezoned and able to be developed into residential properties, and also upzoning. So taking this all into consideration, the final figure is the land sale of the government. So we have been very prudent and very careful. Another example is on the office and commercial property. As you may have realized, since 2023, we stopped rolling out any office land because the demand-supply situation. We let the market digest the oversupply of offices, but at the same time, we also roll out some more innovative measures to help digest the existing stock. For example, we encourage some office properties in certain areas, suitable locations, convert into student hostels. This is just some of the examples.
Yeah, we've heard when it comes to commercial property, right?
Yep.
You have so many international firms that are setting up offices here.
Expanding
the
as
market
well.
is getting people excited and coming back to Hong Kong in some ways. We talked about the IPO pipeline, which you think remains strong. You think will be better than last year in terms of fundraising?
Why
Confident?
not?
Why not?
Of course.
Okay.
Yeah.
I have to ask, because we have a lot of big IPOs coming up in the US. SpaceX is the one that comes up first later on this week. We have been reporting, sorry, my mic, that Hong Kong and Chinese investors have been barred from getting a piece of this IPO. Do you know anything, have you heard of anything? Why do you think we're seeing this right now? Because it seems like it's about national security concerns, but what are you hearing?
And there is also unilateralism there. Well, previously, you must have heard about banning Chinese companies to be listed on the US exchanges. We don't think it's a wise move. In a way, we in Hong Kong could be an unintended beneficiary. These companies will come to Hong Kong for listing. But looking forward, I think for us, what's important is concentrate at doing the right thing, improving our listing regime, promoting various measures to enhance liquidity, quality-wise, be stringent, defend our reputation, then Hong Kong will continue to prosper.
Are you surprised that Hong Kong investors have been lumped in with mainland investors? I don't think I've ever heard something like that in the commercial space, right? You hear about that, about Hong Kong is part of China and whatnot, but to lump Hong Kong investors and Chinese investors and bar them from participating in a US IPO, what do you make of this sort of
I think
trend?
that this is detrimental to your US interests. Why don't you welcome the liquidity from all over the world? Yeah, I think this is, for us, when you look at Shanghai, look at Shenzhen, we have huge number of excellent tech companies at very attractive valuation, waiting for investment. No matter it is IPO or private equity, VCs, or even patient capital. Nowadays, through the Hong Kong IC, we have been channeling sovereign funds from the other jurisdictions and long-term funds to co-invest with us into industries of the future, hard tech, health tech, life science projects. So plenty of opportunities. I think for Hong Kong, as I mentioned, concentrate to do the right thing and work with different partners to the extent possible, will continue to prosper.
The reason for the restriction was because of national security risks. This is critical technology. How would you define then what critical technology is? Because wouldn't any AI company then be in that realm?
Oh, you should ask the US administration.
How do you see that play out though? I mean, you are yourself in the budget was advocating for new listing rules to attract more of these Chinese aerospace, commercial aerospace companies to list here for Hong Kong to become that fundraising hub for them to go global, right?
Yeah, for us, grab this opportunity to grow stronger.
Okay.
Yeah.
Okay. I was going to get your take on, there's this big, massive story that we talked about today about China and how they're spending, I think it's about 2 trillion RMB, nearly $300 billion in terms of building AI data centers in China domestically. How do you think Hong Kong is going to fit into that?
Well, we are also building our own computing capabilities on this multi-pronged approach. Apart from computing capabilities, I think what we bring to the table is the international use case scenario, the international data, and international talent. So play to our strength. They have their strength. They are very strong in their basic research, in their modeling, large language model for the domestic market. But when these tech companies need to go overseas, need to expand global, this is where we come in. We come in with capital, talent, data, computing capabilities, and user case scenario. So we can work together.
One last question. A lot of economies are dealing with this right now, the haves and have-nots of AI, where it really is kind of dividing the winners and losers and the distribution of wealth. How does Hong Kong, as a financial secretary, how do you deal with this kind of K-shaped economy?
Well, AI training for all. This is something we have to embrace. We need to learn it. We need to understand it, use it, and use it well. Then you will find this is so useful and helpful and make life even more wonderful because you will have more time, not to do the repetitive work, but for you to think and for you to find new opportunities.
How are you using AI now, I wonder?
This is a great
As
question.
a financial secretary, how do you incorporate AI in your work?
I believe the information I gave you, some are from AI.
All right. We'll have to fact check some of that. Okay. Secretary, it was a pleasure. Thank you so much for joining
Thank
us
you,
here
Yvonne.
on stage.
Thank you.
All 10, everyone. Thank you.
Very kind. Thank you.
Please welcome to the stage Susan Chan, Head of Asia Pacific at BlackRock, for a conversation with Bloomberg's Rebecca Sin.
Good morning, everyone, and thank you so much for joining us here today. This room is packed, and we're excited to have Susan join us. Susan, I know you just flown back yesterday late last night, so thank you for being here with us. So let's start with, how's business been going?
Good morning, everyone, and thank you. Pleasure. Business is doing really well. I have to say that, and probably everybody will hear the sentiment, the previous session, Hong Kong's really booming. So we're seeing this across the region from a asset management and growth perspective. So.
Business has been going well. Volumes are up, as Paul Chen said, 400 billion. If we think of how investors are allocating from an asset allocation perspective, what are you seeing across BlackRock?
So in terms of allocation, Asia continues to be a region that really embraces active strategies. So we are seeing the growth continue around the active mutual funds. We are considering to continue to see growth in ETFs, something very close to our hearts. And more and more, though, we're also seeing allocation into the private markets. So really three key themes. Let me just touch upon the active side for a minute. So in active, what we do see is the desire for more thematic funds. We see the play on income continue. Income story is no stranger to us in the region. Everybody wants income, so now people are looking for diversified methods to generate that income. In particular, we see high demand for hedge funds. We see high demand for systematic funds as well. So that has been the lion's share of the growth coming from across the region.
So if we drill into the active, as you mentioned, what some of you may not know is Susan and I both started, we know each other from ETFs. Susan was head of capital markets at BlackRock for iShares, and as you know, ETFs has grown significantly. In Hong Kong, it's now surpassed 100 billion in assets under management, and active is a big thing. To your point, in Hong Kong, there's a lot of active ETFs that provide very good income. And Hong Kong, amongst Asia Pacific, is one of the highest in the region. Some of the ETFs provide more than 20% income paid on a monthly basis. So as a house that has both active and passive, how do you see the two coexisting?
So we fundamentally believe that we needed to bring the two together, and we did this when we brought BGI into BlackRock. And that narrative has absolutely played out in the sense that all decisions are active decisions. Whether you're choosing an active fund, whether you're choosing an index fund, whether you're choosing a private market investment. So I think that's how it's playing out. What I would say is that it's incredibly exciting times right now for us, for all of us in the industry across the ETF space. Globally, ETFs are around 22 trillion. In Asia Pacific, it's only north of 1 trillion. So just think about that for a moment. The other stat is today, Asia Pacific accounts for 18% of global assets under management for our industry. That's expected to grow to north of 25% by 2030. So if you couple those two numbers together, what you'll see is there's going to be tremendous growth in ETFs. The size of our capital markets across the region, one would expect that that 1 trillion can go to 10 trillion, can go to 20 trillion, if all the countries focus on driving and growing their capital markets.
I think to leverage off that point, for us, within Bloomberg Intelligence, our estimate is that ETFs globally will surpass 50 trillion by 2035. So right now we're at 22 trillion, but we expect it to surpass 50 trillion. So definitely tremendous growth across that. Now you mentioned about thematics and themes. Can you comment on the recent AI tech sell-off?
Let's see. I think it was mentioned, there's an IPO. There is a listing that's going to happen on Friday. There's been a lot of talk about how are you going to fund these big mega IPOs. Some of the sell-off is to raise cash, right, to invest. Another sell-off is simply what's happening in the Middle East. So we do have some macro forces that are creating some events that has caused the Friday sell-off, the Monday sell-off. But then yesterday, the markets did rebound. And this, to me, is showing that clients are willing to put money to work. Every sell-off, we don't see a rush to de-risk. If anything, we do see selective position risk on again, and we're seeing that yesterday. So I think, this is an opportunity for us to look at where there are pockets to generate that alpha return, and our investment teams are doing that. Our clients are expecting us to do that. Sure, the markets are volatile, but when markets are volatile, that is the opportunity for us to generate excess return. So I think it's fine for now. It doesn't mean that the markets won't correct 20 or 30%, right? But I think all markets globally has proven to be incredibly resilient.
I think if we look at the markets, they have performed phenomenally well. And if we shift gears slightly into crypto and tokenization, crypto, you guys do have the largest Bitcoin ETF globally. Let's talk about crypto. Hong Kong's trying to be the crypto hub. We've done a lot in tokenization now. In Hong Kong, you can buy an ETF and then switch it into gold and get gold jewelry or gold bars back. What's BlackRock doing in this space?
So we have, as you mentioned, we have our crypto ETFs. We continue to see demand for that, and that will continue. We are working across the region in many countries to see how we can bring that capacity into the countries. We've actually listed in Australia, and we're looking at other areas that we can do more in, including Hong Kong.
So if we look at the investment opportunities across Asia Pacific, where does BlackRock see as the most compelling investment opportunities?
So I think there's a few areas, right? So if we look at countries, because of AI, we're seeing structural shifts. Where are they taking place? Well, Korea, for example, is one big shift. If we look at what's happening there with just the AI theme playing out and taking companies like Samsung and Hynix to an incredible level. And even last week when we had the MSCI rebalance, the weight of Korea in the EM markets went from 8-9% to now 22%. These are fundamental shifts that are not going to, revert. So that's Korea, that's Taiwan. In addition, we see Japan as a destination now because of the end of deflation. Of course, that's going to take some time to play out, but there is a lot of interest in Japan. In particular, in Japan, I would say, is in the private market space, in the private credit space, in the infrastructure space. So that's another area that we see a tremendous opportunity. And then in the ASEAN countries, what we are seeing is this need for diversification and this need to want to invest outside of home country. Part of it is driven because of the weaker currencies in the ASEAN countries. They need to diversify to have dollar assets so that they can balance their portfolios over time. And broadly, we're seeing clients wanting to further diversify. What I would say, Rebecca, is that the traditional 60-40 type of portfolio allocation is really underperforming. And we're finding that the need to think about that portfolio on a holistic manner across both equity, fixed income, private, public is really critical today. We're also seeing that you have to look and be very deliberate about how you select what's in each of the categories. It's no longer that you can just go buy an active equity fund and expect to generate the returns in active. And also, there is the demographic challenges of every country in Asia. And we are living longer. We have pension challenges across all. And portfolios of the traditional 60-40 are not going to generate the outcomes that we're going to need for the future. So this is why private markets is becoming such an incredibly powerful asset class within the longer term portfolios, because you need it. And it fits very nicely in so many ways, right? In terms of long-term returns, when you're saving for the future, you're less dependent on short-term liquidity, but you need to be able to see those returns, and also what you're investing in private markets. Nowadays, we always look at how do we help the countries. So infrastructure, you invest in country. So it's a way for you to also, as an investor, have a part in the development of your country.
So you mentioned private markets. It's very hot right now. You guys are heavily invested. You made 3 large acquisitions recently into private markets, but there's been a lot of negative news around private markets, especially private credit. Investors not being able to get out of positions. There's been a shortage. What is your take on this?
So don't always believe what you read in the press. Headlines are meant to be sensationalized. That's number one. Listen, there are pockets of issues in private credit, but it's really very idiosyncratic, and it's very unique at the moment, okay? If we look at the overall categories, they are doing well. They are offering the diversified returns. And we at BlackRock, you said we made the acquisitions, we firmly believe that you cannot build long-term portfolios without going into areas like infrastructure, like private credit. I would say that, with any portfolio, you have to look at it on a risk-adjusted return basis. You also have to be able to due diligence and deploy your capital where you feel is, the right area. So, I think, sure, there are some pockets, but if we look at the grand scheme of things in private credit, the default rates are still very, very small.
And then you mentioned portfolio construction, traditionally the 60-40. How are investors constructing portfolio now? To your point, there's so many different products out there available.
So what I would say is there is probably the adjustment of 60-40 within the public markets, and then increasingly we're seeing allocation into private markets. So some of you may hear people saying 50-30-20, of which 20 is in private markets, or, there's a blend. So we're definitely seeing more and more of that whole portfolio holistic look as into the equity piece, the fixed income piece, and then the private piece. And it helps to boost your longer term returns.
So you mentioned previously income. In Asia, typically investors will invest mainly in cash and property. And it's very different to the US, where people have retirement funds, they're using ETFs. How are investors different in Asia than the rest of the world, do you find?
Well, I don't have to tell you, and we all know, Asia traditionally will save a lot in cash. But this is what makes Asia so exciting, because we are seeing that shift gradually, right? Where savings is moving into investments, where most of our clients are seeing that if you did not invest in the capital market, you would have missed out. Last week I was in Shanghai, and I spoke, and I gave a number that kind of was fascinating to everyone. So here's the number. If you invested $1, right, into China's equity markets over the past 20 years, you would have on average generated 6.5% per annum, okay? That is extraordinary. That's like more than 300 times over the past 20 years. If you sat in cash, you would not have done that, okay? These are just, the beauty of compounding in capital markets is incredible. Now, if you do that in every single market, you will see and you will convince yourself that you should not be sitting in cash only. You may want to sit a little bit, but you should not be sitting in cash only. So we do have to start investing in local capital markets, and of course, the diversification into global markets.
So if we look across the region and across the product offering, there's a lot of investment opportunities. Where do you see are the most undervalued opportunities within Asia Pacific?
So listen, I think China, because we went 18 months ago where globally the world was like, China's not investable, China is not investable. Today, we're seeing a lot more attention on China. The valuations are, on a relative basis, cheaper. There is value, and there's a lot of value. And I think we're going to see that play out as the mega forces of AI start to play out, as this theme of Asia for Asia, because our investors want to invest more closer to the region, plays out. We're going to start seeing that clients will look towards those undervalued plays. So I definitely think China is one. The second one is Asian credit. Asian credit yields incredibly well. It traditionally has not had the attention, and I'm saying public credit. It traditionally has not had the focus because of the fact that it's largely a primary activity tool, and secondary liquidity is less. So we all need to do some work there to promote and get secondary market active liquidity up. But Asian credit, we see tremendous opportunity in that category as well.
So if we look to the next 3 to 5 years, you mentioned China, Asian credit, any other sectors that you think will outperform? Or what would be the best ways for investors to express their views?
Well, I think, again, construct your portfolio with the blend of, you're going to have to invest in the US. With the largest capital markets, it's very hard to stay away from it. But I think for every incremental dollar that you're putting into the markets, think about how you should diversify, both as a hedge, but also as a diversification, because certain pockets, yields are higher in Asia, right? So we do see home country investments in all countries as something very important. The AI theme will continue to play out, but it's going to start going downstream. So think about that downstream effect and what other segments within AI and what other sectors are going to benefit. Obvious ones are going to be healthcare, biotech, et cetera. So look at how to diversify on that. Blend fixed income, blend Asian fixed income. That category is incredibly, incredibly resilient and is a great diversifier. And then lastly, private markets. And I think in private markets, for us, it's about infrastructure. It's about private credit.
So if we look at what Secretary Paul Chan has said, did you have any comments off of what he said?
I agree with what he said.
Hong Kong's going to be the hub. Before we end, we're asking every panelist this question: how is your organization using AI, and what's the impact to the job market?
So at BlackRock, we've been leveraging AI for a long time in certain parts of our business. We have a systematic quant group that has been experimenting and leveraging the AI tools for more than 2 decades. So that's number one. Number two, we are looking at how we can further embed AI into our processes. But what I would say is it's very early innings right now. Everyone is experimenting with AI, and we know that it will help to increase productivity. We know that it will help make our day jobs more efficient. So that's for sure. What I would say is that, the use cases of where we will apply AI has to be structural, strategic, and it has to be on a scale level. Okay, and sure, everybody will have their co-pilots, et cetera, but I think that is just sort of norm. So we're still testing, but I would imagine that we're gonna, have multiple use cases.
Hopefully you did not use AI to come up with any of these answers.
I did not, because I didn't know what you were gonna ask me. So, and then also I think you asked about talent. So, again, I'm going to talk about in terms of talent and the use of AI, we do believe it's a way to enhance and make our folks and our day jobs more efficient. Sure, we're talking about what new jobs don't exist today that will come in the area of, for example, governance. We're talking about what tasks can be leveraged and how we can retrain our colleagues to move up the stack. And I'm super excited because if I get an hour back, I can do many other things in that hour. So,
thank you very much for your time here today. And with that, I'd like to give a round of applause to Susan.
Thank you.
To be effective in Asia, you got to understand everything.
See one cockroach, there are probably more. And so everyone should be forewarned on this one.
Please welcome to the stage Jenny Lee, Senior Managing Partner at Granite Asia, and Ming-Chen Xia, Managing Director and Co-Head of Asia Investments at Hamilton Lane, for a conversation with Bloomberg's Lulu Chen.
So we're seeing a revival in investor sentiment towards Asia and China-based PE and VC funds. Fundraising activity is rebounding, and AI is rising as a powerful catalyst for all of these events. So we're here to discuss the opportunities and risks shaping the sectors. Before we dive into the panel, we do have a poll for all of you in the audience. If you scan the QR codes, we can see that we want to see your view about where you see the strongest growth potentials in private markets, and later we'll dive into that in the session. So for starters, Jenny, I'd like to ask you why you think that we're seeing all this fundraising activity in the past year and a half, and also, is there enough LP appetite to support all this activity?
Great, thank you, Lulu. Very happy to be here. Well, I have been in the private capital or private investment area for close to 2.5 decades, coming to 3 decades, 30 years. And I would say that in the private market or private capital perspective, the fundraising cycle generally is on a 3 to 4 year pace. And triggers for whether the fundraising cycle is accelerated or prolonged is highly dependent on 2 key factors. I think one is there a specific tailwind in terms of technology disruption, in terms of broader market change that's going to create new ideas, new companies, and new products in the market. Well, I think for us, the answer is yes, right? Today, in every single conference that you talked about, obviously the whole AI transformation is changing industry, not in small ways, but in very broad ways, and we can deep dive later. Then the second trigger, which is actually a very important trigger, is the liquidity at the end of the closed fund, right, private capital. And so for the last 4 to 5 years, I have to say that the IPO market has been shut, not just in particular regional markets, but on a global basis. Now, as we all heard this morning as well, Hong Kong is top of the chart, league tables in terms of IPOs. We'd like to see that continue, not just in Hong Kong, but on a broad-based basis. And if the IPO market can stay healthy, can stay open, then I think you will close the loop on private capital. So with that as well, right, tech transformation, close the loop. investors do need the capital to come back in the form of distribution and cashback and returns. And so with that as well, definitely managers will then be in a position to say, hey, let's raise a new fund to capitalize on the potential investments and new ideas. But also I'd like to add, right, in the private capital world, it's all about the power law, right? You can call it, the K-shaped dynamic or the power law. Even in the AI world, we're talking about, the power law of the frontier model. And so similar managers in the private capital markets, the matured managers do enjoy, a bit more excitement around, their new fundraise, their new products. And so I think from a capital perspective, it also does flow towards a bit of that power law, which is the top 10, top 20 managers on a global basis. So I would say it's not bad for everyone. It's not bad for every strategy, but for managers that's been consistent, long-term, delivering consistent return, measured in terms of how they build their portfolio and their pace, I would say look at this asset class on a 10-year horizon, but not a 1 to 2 year horizon.
Yeah, so we're simply in that cycle, the exit strategies help, and also the top performers are taking most of the money. And Ming-Chen, that's a perfect segue to you. You're sitting as an LP, have a broader view of all the funds. How are you taking all of this demand in the market, and what's your view on it?
I think in the last 1 to 2 years, we clearly see the recovery of the interest level from the international LPs for Asia private markets, particularly for China. As all we know, after the peak of 2021, China has entered a downturn in the last few years, quite challenging. A lot of funds had very big challenges to raise a new fund. I think after the maybe late 24 and also the 25, we've seen a very strong recovery on the public market, as Jenny mentioned, and also a lot of interesting investment themes come out of China, AI, and also a lot of go abroad, buyout, and also not only China, we also seen a lot of non-China Asia markets like Japan, India has also growing very well and attracting a lot of international capitals. So for China specifically, because we're talking about China more today, we've seen quite a few top-tier venture capital manager have raised the new fund, and which is very encouraging. But unfortunately, on the other hand, many of them have cut back the fund size to like 50%, 60% of the prior fund. So they're raising a smaller fund. They're investing more focused on the strong momentum right now, like AI, robotics, and other hard tech, deep tech innovation of China. And on the other hand, we're also seeing the increase of buyout investments in China, which is also a phenomenon that you see in some mature market. So like Japan, Korea, Australia, in Asia. So in China, we also see the increase for buyout as a result of the consolidation of a lot of industries and supply chain restructuring, and a lot of business succession of the first generation entrepreneurs. So a lot of interesting themes also happening in the bio space in China. So, and we definitely see the capital moving a little bit from the other regions to China, to Asia, as diversification. And as we all know, in the last few years, we've seen a very, very high level of concentration to the US on both the public market and the private markets. Particularly for the private markets, very, very high concentration to AI. We don't think this is a very healthy situation, but some capital are already started to diversify a little bit to this region.
Yeah, that concentration in AI is something I want to talk about. So both of you have exposure to AI. What, in your view, is the real gap between how much of a gap does China have with the US? And we can talk about like the different sectors, and also how much time is there between the chip race, the time lag between the chip race. Jenny, do you want to start first?
Yeah, so I wouldn't characterize this as a gap. Well, AI has been around, machine learning, traditional has been around for the last 20, 30, 40 years. I think what really was exciting was the OpenAI ChatGPT moment, which was the early 2024. And then, of course, in 2025, we have our DeepSeek moment. And frankly, if you look at where the frontier model has emerged, whether they are closed or open source, this all happened within the 12 to 18 months time frame, right? And so very quickly, the world got to know about frontier model. And whether you are using, your ChatGPT or your Anthropic or your DeepSeek or your Llama or your Gemini, the underlying, if we were to call this operating system for AI compute, actually it's already there. And very quickly over the last, the 18 months, I think that battle there has now shifted into the stack, right? And so it's no longer about, who has the best frontier model. To be fair, the scaling law has plateaued, and therefore it's the differences on that frontier model portion is very minimal. It's really now about application. And so and then it's about, and obviously on the frontier model as well, it's also moved from the private capital market very quickly into the public market, right? And so from a private capital or a private capital VC investor, then where we are focused now is where are the problem sets, where are the industries, where are the verticals that's going to be enhanced, whether it's AI native or AI transform. In this case, I think we have seen that in the US market or in the West, a lot of the SaaS, software type processes, whether it's around legal, security, as we all know it, audit, I think there is a lot more emphasis in terms of the AI transformation on process, on kind of software-defined process. On the Asia side, the issues and challenges that we face is a little different. SaaS had never taken off in Asia over the last 20 years, simply because the state of the economy here is very diverse. We're emerging, we've developed, different GDP per capita, ability to pay for software type services is not there, right? And so in Asia, I think where AI comes in, it's actually down to the industries. So we are seeing factories transforming themselves, whether it's automation with robotics, embodied AI, with physical AI, with agentic AI in the bots, in the hardware, in the machines. That's one area. The second area we are seeing is actually AI for science, right? And so the Asia broadly has 5 billion of the population here, and therefore different different regions actually has different healthcare related issues, which I think the challenges does then presents itself where if AI can transform, this is where we are seeing AI native transformation in the area of healthcare, in the areas of medical device, in the area of drug discovery. So yeah, I think the world is better off because we are focused on solving different issues that's pertinent to each of the region. And I think that the world will be even better off if there's a lot more sharing, among the entrepreneurs and on the trends perspective.
So focusing on the hardware, robotics, and also AI for healthcare, that's where Asia is seeing its strength.
Right. Local challenges that it's going to be more transformative for the general population.
Yeah. And Ming-Chen, what's your view on that?
Yeah, I think in terms of the comparison between China and US in the AI space, I think both countries will continue to compete, but I think they are taking a little bit different approach. I think in a large language model side, personally I feel US is still leading. To what extent, I'm not sure. Maybe Jenny knows better, but I think on the surface you see the strong revenue growth for some of the leading models in the US. So I do believe the valuation, to some extent, is really well supported by the growth of the ARR. But I don't think the gap of the technology is that big, right? So Anthropic is raising a new round. How much is it? $950 billion, right? The valuation. But you see some leasing company in Hong Kong. The model here is 500 billion Hong Kong D. The gap's 15 times, 20 times for the valuation. I don't think the gap is that big, but it's really the problem, the difference of the commercialization, the capability of commercialization. Why is it different? Because the US clients, global clients, are very willing to pay to purchase these this service. But in China, we don't have a very strong tradition to pay. This is why we don't have SaaS industry at all. And we're worried about the SaaS partially will be replaced by AI. But good thing here is we have nothing to replace. And so I think on the model side, we still see China, US leading. But on the other hand, for the physical AI, like robotics, autonomous driving, and industrial automation, those areas are definitely China's leader and is much more advanced than other countries, including US. This is supported really by the very comprehensive and sophisticated manufacturing capability, and also the large pool of talents, including scientists and engineers. So US doesn't have that. I think China will continue to lead. And also very importantly on the valuation, again, even for the similar kind of business in a similar commercialization stage, the Chinese company is still, the valuation for Chinese company is still much less, much cheaper than US peers. This is why we think here China AI is very attractive to invest, and from both technology and valuation perspective.
Yeah. The challenges you mentioned about selling to companies to be model has always been there, and that's probably why this part of the region is more leading in terms of commercial applications, and also DeepSeek is in no rush to commercialize either. So I have a question about the post-Manus world. I know neither of you are in those deals, but as an investor, what is your advice for companies starting their business today if the founder were to want to sell to the world and be a global business? Where would you advise them to, how would they build their business from day one?
Yeah, I would say that, the world has changed, and because of that, when we talk to our founders, the conversation has gone from efficiency-based to more resiliency-based. And in a more efficient world, it's about where do you build your one large data center? Where do you build your one manufacturing facility? Where do you house all your R&D? Because in efficiency base, you need scale and you need leverage. In the new world, as we know, I think markets are different. Even when we talk about AI, the willingness to pay by the end customer in each of the market is different. And so in a more resiliency-based conversation, really it's about, what can your product do? Where can it be sold? Who are the most likely first phase or second phase customers, then that's maybe where you put your go-to-market engine. In terms of R&D, I would say that in the new world, obviously with AI as well, it's also about data. It's about model access, it's about data, it's about how much of the processing are you going to do. And so in that sense, it also means that founders have to start to think about multiple provisioning points, right? Whether it's to house their R&D, their IP creation, as well as how they manage data. So in that sense, today's companies do have to have multiple points. And then the last one is about manufacturing, right? If you're building robots, or while we definitely, I think in terms of talent, in terms of ecosystem, in terms of access to sensors and all the different pieces of the manufacturing ecosystem, China is a very strong ecosystem in terms of the process and the talent. But the reality is that customers want the manufacturing closer to them. And so even for founders, when they think about manufacturing, it's not one big factory for the world. And therefore, what we are seeing is that there's probably a China for China, a US for US, and then somewhere else for the rest of the world. And it does require, while AI is supposed to be more efficient, but today in trying to be a global company, it means that on day one, the capital, the thought process that goes into structuring the right company to be in the right place, right time, right market, right customers means that there will be more expense associated with them.
And do they have to do it as early as possible?
Well, so I would say that if you're a first-time entrepreneur, then definitely, right, you have a clean slate and you're looking at where the world is and you can position yourself the right way. If you are an existing large company and, then I think, and you're looking to spin off your companies, then obviously the conversation is a lot more nuanced. I think our advice is always, be what you are, right? I mean, if you have China's strength, you should leverage on the China strength. If you want to go to market, in international market, find partners that will allow you to land. Some markets may be off limits and it's not where they should go, right? So I think for the mid to later stage companies, the conversation is a lot more nuanced. And I think that it has to be also very transparent. We always said don't try to be cute because the world isn't cute, right? And information, transparency, it's all out there. Your customers know, you yourself know, and so whatever you do in terms of structuring your business, just make sure that it can stand the test of conversation, or you can stand the test of media headlines. I think maybe that's the litmus test that our founders found after they decide what they want to do, to go through that litmus test as well.
Standing the test of conversation, meaning the optics are as important as being legally compliant.
Absolutely.
Let's have a look at the poll that we did earlier. Where is your highest conviction in Asia private markets over the next 2 to 3 years? And our winner is growth equity. That's a perfect segment into our next question about where you two are putting your money in. Jenny, you mentioned about the robotics and healthcare companies. I'm curious about your investment strategy and what companies you're investing in.
Well, I think at the top level, that Min Cheng and I, we are very bullish on Asia. I think if you look at global capital, Asia, in terms of allocation, has gone from like 10% of global allocation down to maybe 5%. So we are nowhere near, back where we are in terms of capital coming back into Asia. But Asia broadly, as we talked about, there are 3 centers, right? Japan, China, and India. And we are seeing a lot of growth here. And so I think just reacting to what we're seeing here, I would say that we continue to see with AI transformation, not just early AI native companies coming out, and therefore the venture capital market is coming back. I would say stabilizing on the way up with quite a bit of excitement. But where it's quite transformational is that we're seeing mid to large cap companies really thinking about transformation with technology. And how they can better position themselves. And so having access to whether growth equity or private capital, private credit, I think that's where we are also seeing a lot of excitement as well. I just want to maybe add that. And then I think Lulu and I, we were discussing about, if I'm investing just on my personal perspective and I'm looking at 10, 20 years, what is the one area, if I can only pick one area, I would say that I would double down on AI plus longevity. I think I like to be able to do this, every 5 years. I've been doing this for 25 years, 26 years, maybe we'll do it for another 3 decades. And to do this well, we would need AI for longevity to actually come earlier.
And Min Cheng, you're investing in funds, right? So what types of funds are getting your pick these days?
So we have a lot of different strategies, different funds, and there's a lot of things to do to invest. I remember you asked me on our prep call, so how to build a portfolio. So I'm a private market specialist, so I don't comment on the public market, but we have a very strong bias towards private markets. So if I think about my own portfolio, I would put 50% of money to the private markets, not 20, 30, as some other would say. So 50% of your portfolio to private markets. Within that 50%, I think on geography allocation. So I would still put like 50, 60% to the US, because the US is still the largest private market in the world. And other than US, maybe we can put some 20-ish in Europe, and then 20, 30 in Asia. Again, we have strong bias towards Asia. So if you are neutral to Asia, that's about 10 to 15% of the global market. That's neutral, right? But we want to maybe overweight a little bit at this point. And that's by geographies. By strategy, I would think globally, buyout is still the largest part. So maybe, again, 60%, even 70% to buyouts, and then the remaining 30% for venture and growth. From a long-term perspective, venture and growth has been like actually 10 to 20% of the global PE market. So right now, people are getting crazy on venture because of AI, but from long-term perspective, I think 30% is roughly a reasonable allocation to venture growth. I know this is very boring. We are boring investor, and that's a very long-term, stable, and a diversified and a safe portfolio, I think, for your money.
I'm curious about the dynamics between the LPs and the GPs these days. Out of the US, we're seeing much tougher clauses and also negotiation terms. What are you seeing on your side of the table, and what's the conversation like? Where's the strongest tension points?
Yeah. I think a few, 3-4 years ago, after the downturn, we clearly see the LP are taking a little bit stronger position in the dynamics. But I think we see the market is starting to normalize and will continue to normalize to a level that the GP LP dynamics will more based on the quality of the investment, quality of the funds, quality of the GP. If you're very good, very strong GP, you tend to take a stronger position in those in this negotiation.
Looking at each other.
And so it's really depending how strong your willingness to invest in this fund, right? So I think we're seeing the normalization of that dynamics. Yeah.
If I may jump in, I think let's just, on venture capital as an asset class, if you look at the returns on a 10-year horizon, has always been probably the best asset class on a 10-year horizon. Of course, venture capital over the last 5 years is the worst asset class, right? Because of the lack of liquidity, the IPO, and of course, prior to the AI moment, I think there was also a bit of a limbo in terms of where the next technology innovation is coming from. So if you look at the 1-year and 5-year return on venture capital, I think you're talking about maybe the teens, and this is average, right? 10 to 12% from a return perspective. But I want to highlight a point that Ming Chen mentioned, and that's the dispersion between a top tier, first quartile GP and the last year is easily a 30%, so 300 basis point of returns. Right, so if your average is at the 10-12%, then the best managers could be generating 40-50% of IRR. And so I think when you are in that camp, you would have a lot more bargaining power when you think about consistent returns and terms negotiation. Yeah. Obviously, if you're in the long tail, then it's going to be a much harder conversation.
And in the secondaries market, quite a lot of activity on that front. How much discounts are we seeing for these types of secondary funds?
Yeah, I'm very happy you pick up this topic. I also see that 20% of the audience are picking secondaries as their asset class. They have high conviction. I think this secondary market is growing very fast in Asia, and we're seeing a lot of interest right now. But in terms of the supply-demand dynamics, I think still we're seeing a lot of investment opportunities, but on the other hand, the capital is, relatively speaking, is still very limited. So this is why we still think the secondaries market in Asia is still a buyer's market, and we still have the luxury to pick good assets, good GPs, good funds to invest, and still the discount is still relatively larger than the similar type of opportunities in the US.
For example, that range?
Yeah, for venture fund, sometimes the discount range can from 20% discount to 50% discount, sometimes even higher. For the buyout, maybe 10% to like 30%. So venture tend to have deeper discounts given the early stage nature of the portfolio and assets. But also this is also highly related to the funds, the quality of the GP of funds and underlying assets. So this is why to invest in secondaries experience and the knowledge.
If I may quickly add in, I think when the IPO market opens, actually the secondaries asset class will actually go down in terms of priority. Simply because for companies, to be fair, we are seeing companies go public shorter time, faster as well. And so if the IPO market can stay open, I would say that the same companies that may be looking for to exit right through secondary sales, or LPs looking to exit for secondary sales, probably will tone down a little bit, right? Because then these companies are then getting to the end of the exit pie. So if anything, I would say private credit is probably a better asset if you're looking at Asia, because it helps to capture not just AI or tech native companies, but also the transformation that would change even category leaders traditional into new, tech transformed companies. So I think credit is one way because it's non-dilutive capital. It allows the same companies to be able to tap the expertise with tech transformation, but in a private credit manner. So I think underserved asset class, definitely worth a seat at the table from the growth that we are seeing in the category.
Yeah, one final question for your fund in terms of exits, what's in the pipeline, whether it be IPOs or M&As?
Absolutely. So across all our equity funds, we've had 6 IPOs in the last 12 months across the Asia markets. We have actually close to 20 companies for the next 12 to 18 months. And again, across the different markets from, of course, Hong Kong takes a big lion's share of this, but also includes, India market, Japan market, and the US market as well. So that's why I said we need the market to stay sane and stay open.
Right.
For returns back to our LPs.
Yeah. One final question. If you had $100,000, where would you put it?
Yeah, I think I answered this, right? I think in that sense, I think AI for longevity would be very cool. And if I were to look at 5 to 10 years, if I can, and said, now let's move on from AI, then there are 3 areas. I think one, quantum computing. I always thought it may be 10 years later, but where I'm seeing the talent and the engineering and the startup that's coming, we think that quantum computing may be here in less than 3 years. I think it's there. Number 2, in terms of energy, a lot of conversations about energy, right? And so nuclear energy, the different components, sensors, startups, there's also a lot of activity here, not just in the big markets like US and China, but across the board. I think governments are taking a very active approach to think about how to resolve the energy issue, and nuclear is a key. And of course, I think last, if we're all tracking the SpaceX IPO, I would say that the conversations around compute in space, A level, we are already seeing, quite a bunch of emerging startups trying to really address the issue of, if you can get compute to space, which is where the launchers will help, then what does it take to build real compute in space? So those would be the 3, so-called next areas or next frontier.
It's a long list, Ming Chen.
I need more than 100.
I answered the question on the portfolio construction, but I can answer the question in a little bit different way. So I think in the private markets, the bright spot for us is 3 things. One is buyouts, as I mentioned. One is secondary. Another is infra. So these 3 strategy within private markets globally, we think are 3 most attractive, interesting strategy to pursue.
That also sounds like a bigger checkbook, but that's all the time we have, and thank you so much for your insights. Let's give them a round of applause. Thank you.
Please welcome to the stage Chris Gradel, CEO and co-founder of PAG, for a conversation with Bloomberg's David Ingles.
Good morning. Good morning. Okay. We don't need a script for this, right? No. Okay, let's put it away, just to make it fun.
Yeah.
Right?
Sure.
We'll see where the winds of conversation take us.
Fire away.
Okay. I'll need to put my phone here just in case my puppy acts up and I need to watch my puppy and see how he's doing at home. By the way, thank you for taking the time to come here today. And I think it's interesting in terms of the placement and how some of the editorial conversations have been curated here. So from Paul Chan, we've had pretty much a very big presence of private market allocations and conversations. We just had one with Lulu, of course, and we have, of course, Chris here from PAG, and shortly after this, Apollo is coming on as well with Eric, and I think that's a really good sort of place to start. We were just having this conversation before we came up here. In terms of how you think global investors are underallocated to this part of the world. I wonder if you could support that with some numbers, Chris.
Yeah, I mean, I think traditionally there has been this trend. You go to the US first, and then you go to Europe, and then you do a little bit of Asia, and you still see that in the numbers where APAC is 37% of GDP, global GDP, but only 15% of alternatives. So, I think the region continues to be relatively underallocated. I have to say, hopefully that is starting to change. We've definitely seen in the last 18 months starting to see some pickup again, as I think, our clients we talk to are generally all looking for a little bit more diversification in their portfolios and starting to look more at the region as well. So, on the positive side, that means there is, relatively speaking, less competition, so that's good.
Right.
But I think overall it's still, very much underallocated. And I guess we'll talk about some things, but I think there's actually some real positive factors that hopefully should change that over time.
What do you think the reasons are behind that underallocation? Is it home bias? Is it lack of opportunities? Is it politics? I think
obviously there's been a bit of geopolitics in recent years, which has affected some China allocations perhaps. But I think, there's still, I was talking to one allocator yesterday who still said, oh, we do whereas the US and Europe have actually seen a reduction, greater concentration. Asia total market cap is now more than double Europe, and trading volumes are 8 times Europe. So, I think there's a lack of appreciation in just how much markets have grown, the depth of markets, and the quality. Again, one area we're active in is convertible bonds, for example. 80% of Asian convertible bonds are large cap versus 50% in the US. The Asian convertible bond market is bigger than the European convertible bond market now. So, there's quality, liquidity, has grown dramatically, and obviously it's easier to quantify that on the public side, but you also see that on the private side. So I think, there've been some fundamental changes as these keep on developing that, haven't quite perhaps been recognized yet in allocations, but that should hopefully change.
Private credit's come up, as you know, I'm sure you've seen the news. Where are the best opportunities in your view for private lending, as far as you guys are concerned?
Again, I think Asia is a little bit different on private credit to US and Europe. US and Europe very much dominated by corporate, dominated by sort of mid-market lending, sponsor-backed financing. Those are the big sort of giant blocks of private credit. And, when you look at Asia, the markets are just a little bit better banked. The lending gap is smaller. The regulatory and, burden on the banks has been a little bit less, particularly on the corporate side. So, we've just seen less opportunity there. The pricing is not so interesting. Where Asia has seen more regulatory sort of pressure on the banks in terms of capital charges, it's been on the real estate side. So we actually think that, that's where, we're one of the largest private debt credit firms in the region. stuff, which, so you're going up the risk
curve and everything else. Okay.
Yeah.
Before we get into China, because once we get into China, that's quite a deep hole we'll get into. But just the opportunities outside China as far as real estate and your franchise is concerned, like what's been most active for you this year, and where do you think things will remain active?
Yeah, so real estate, again, is a major business for us. We're, I guess, most active in 3 markets currently, Japan, Korea, and Australia and New Zealand.
Sure.
Japan continues to be, a great market. Again, that corporate governance reform theme pushing through, there's just so much activist capital now pushing public companies to, streamline, sell non-core businesses, so it creates opportunities for private equity, but also, corporate Japan still owns huge amounts of real estate, which really is non-core to the businesses. So just earlier this year, we led the acquisition of Sapporo Beer's real estate portfolio in Japan, which was a $3 billion transaction, and we're seeing, again, just more and more pressure on companies to sort of sell their non-core real estate. So we think this is a theme that has legs, and that corporate governance theme, again, drives lots of opportunities in Japan across multiple asset classes.
Let's bring China in.
Yeah.
I guess the starting point there, just to build on what we started on, just how underweight global investors are. So maybe just a mental exercise. Let's say you went to the US, a room of 10 people, and you brought up the topic of China, how many would remain in the room? How many would walk out?
I'm not sure they would. I'd hope they wouldn't walk out, but yeah, I think there's still probably 9 out of 10 people will just not do China in the US. So let's see. I think maybe there's a little bit
Has that changed?
Friendly relationship. It hasn't really changed yet.
Okay. I
think a couple of years ago, maybe people didn't even they weren't even interested in asking, I think now people at least are interested again from a macro point of view, what's going on in China, but not allocating capital yet. Maybe a little bit on the public side, but on the private side still, I think there's, from the US, not much interest.
Sure. Your call on China is underpinned by your view on the macro.
Yeah.
We've had this conversation, and I think what underpins that macro view is what happens in the property market. I think we have a graph. Thank you so much. Right on cue. Yeah. Thank you to our producers here. I think what you're looking at, just for the audience, this is a month-on-month change in, I believe, new home prices across 70 cities. This is across 6 years. So effectively what you're seeing here is for the better part of the last 6-7 years, it's been declines month on month. As far as new home prices go, what's the direction of travel that you see? And does this need to improve for the macro to turn?
I think, China's growth in recent times have been really largely driven by exports, and consumption has stayed very weak. And,
right.
We believe, we've strongly felt that household consumption is not going to return until the property market stabilizes. This was a major hit to household balance sheets and really impacted confidence. So we've been watching very closely to see, when are there signs of that property market stabilizing, and also watching at the same time consumption to see, because, while this property price crisis has been going on, Chinese households have been saving like crazy. So there's about 23 trillion RMB of household cash savings in the bank. And you only need a little bit of that. 3% of that is a 4% GDP impulse. So we believe once that comes out, it could be a huge demand impulse into China. Some of that will also go into equity markets and other investments. And that can be, I think that's an extra sort of boost to China and the global economy that maybe isn't fully sort of baked into people's assumptions. So I think that is there. But, so I think the property market is looking a little bit better.
Okay.
In first-tier cities, prices are starting to stabilize, even go up a little bit in Shanghai. In second-tier cities, the rate of decline is slowing. You know, we did last year the buyout, we led the buyout of Wanda Commercial, which is the largest
that's right.
shopping mall manager in the world.
Not a lot of people know that. You're actually the biggest mall operator in China.
Yeah, it's an amazing business, actually. So it's very interesting seeing the retail sales data across the whole country. And again, for the first time, we've actually seen the data tick, sales per visitor actually tick positive. And then we do sentiment surveys among staff, et cetera. And again, we've just seen little signs of things turning positive. So I think, this is something which, it may be slowed down a bit by Iran, and if there's some demand destruction on the sort of side through that. But I think at some point in the next 12, 18 months, I think there's positive. You could see a nice demand impulse coming through that could create then more employment, positive cycle through services employment, because again, manufacturing is not really generating new jobs. I think you could see a nice virtual cycle coming through in China. So that's something which, again, we're fairly positive on the outlook for China.
Okay, on the hedge fund side of the business, this might apply to China, it could apply to other markets as well. You firmly believe this is a stock picker's market?
Yeah, I think the market has changed. I think people always talked about the death of active investing, the death of stock picking. It's all passive, huge money going into ETFs, et cetera. And I think there's been some elements of truth to that. But again, we've seen, and it really started, I would say, around Liberation Day, so with tariffs. Okay, a lot of export firms in the region, lots of winners and losers, or relative winners and losers, and started to see dispersion really pick up significantly. Then we also, obviously, we have the corporate governance reforms in Japan, which had a huge impact. Korea now looking and taking inspiration from that with their Value Up program. China also looking at some of those lessons learned from Japan. You've seen dividend payouts go up dramatically in China over the past 2 years. So, we've just seen, we have in our hedge fund, our polymer hedge fund business, we have 70 teams running different strategies across the region, mostly equity, long, short. And we've just seen the hit rates go up dramatically. Just seen dispersion go up, hit rates go up, and performance has been excellent. So I actually think a lot of these factors have some legs as well. Also AI, of course, again, another factor, global factor, creating more dispersion, more winners, losers, outperformance, relative underperformance. So, I actually think could be heading into a really great period for equity, long, short, and sort of stock picking in general.
Sort of within your verticals, then, do you think that specifically hedge funds will provide likely the most alpha this year?
I think there's lots of interesting stuff, actually. I think actually the lending is great, the real estate's been good. Energy transition, another theme we really like. The public performance it's been our record year for performance from our hedge funds, actually. It's been a great environment. Buyouts in China, we think, are really interesting now as well, actually.
That came up earlier,
because, again, there's very little competition. Valuations are reasonable. You can now borrow cheaply. You can borrow more cheaply in China than Japan for a buyout.
That's crazy if you think about it.
Which is really amazing. Yeah. So, I think there's actually lots of interesting stuff, to do across the region.
One of the things I also wanted to, and this is an abrupt shift in the topic, but since you brought up AI, one of the things that stood out to me last week was when you had SpaceX come out and say, we were going to raise X amount of money, it wasn't even the biggest fundraise of the week. I mean, Google came out and did an $80+ billion follow-up placement, and Anthropic came out with I think Series H of 60, 70B. So it's clearly companies don't need to IPO now to raise a lot of money. Do you think it's allowing companies to remain private longer, forever, or do you think at some point the public markets is still the sort of end?
Yeah, look, I think still all these companies will ultimately be public, and I still think the public market gives you more options and flexibility for raising capital.
Sure.
So I think ultimately, but there is a lot of there's more private capital, there's more different types of flexible solutions from the private market. So I think companies have got maybe more luxury of waiting to a point where you're ready. Obviously being public adds a lot of pressure and extra pressures to being a private company. So you probably want to only go public when you're ready.
Okay. From an asset allocator perspective, how much do you think people should allocate to private markets? I know that's an it depends question, but and coming from someone like you, of course, as well, but yeah, give me a sense of what's appropriate.
I don't know. Well, I have 90% of my personal investments in alternatives.
Okay.
Mostly PAG funds, because that's what we have to do.
Yeah, big surprise there.
Yeah, I think, half private, half public.
Half.
But, I'm talking my own book as well.
Right. I was about to say that it depends. Yeah. Well, I mean, okay, it's a final question for you. How do you think your performance has fared through, it's about almost 30 years now, through cycles? You've seen everything.
Well, I think, hopefully, touch wood, we've been around for a long time, so we've survived the world economy and markets throwing a lot of stuff at us. So I like to think we've hopefully been doing something right. I think, there's always going to be some challenges, right? But I think right now performance has actually been very good across asset classes, actually. Again, I get nervous when you look at areas where too much capital is raised too quickly. That's usually when you start to see, a more difficult investing environment. You tend to then see funds underperforming.
Well, how do you know when something is about to become a problem and something that you could ignore? Like, what scares you?
I think you just have to stay disciplined. And, for us as a firm, it's always been very important that we're diversified enough so we don't depend on any one thing. So if an opportunity set goes away, we can just stop doing it. 2018, Australian real estate was getting very frothy. We sold everything. We didn't go back in until 2024. So, I think it's having the flexibility. It's hard to keep that discipline, yeah, I think, if valuations get stretched, well, sell, take profits, I think, and don't be, I think it was Rockefeller or somebody once said, I've become very wealthy by selling too early. So, I think never regret also if you make a good return, yeah.
All right, Chris, fantastic. Thank you so much. Round of applause, please, for Chris Gradel. Thank you.
Please welcome to the stage Eiji Ueda, partner and head of Asia Pacific at Apollo, for a conversation with Bloomberg's Eric Schatzker.
Welcome.
Thank you.
Folks, before we begin, a few things you should know about Ueda-san. His business card says Apollo, but he is a newbie at the firm.
Yes.
Relatively speaking, only what, about 6 or 7 months now?
Yeah, 7 months now.
Before that, he was the chief investment officer at Japan's GPIF, world's largest pension plan.
Now $2 trillion.
$2 trillion. And previously, he spent 3 decades at Goldman in some of the firm's top trading positions in Asia. What else should people know about you?
First, thanks very much for the invitation, and it's a very honor to spend some time with you and the distinguished guests today. Yeah, I think the world demand for investment is very, very strong, because we talk about the demographics, but a lot of the retiree wave is coming around the world. So the investment demand for those retirees to prepare for their retired life is quite strong.
Can we talk about that for a moment? You used a word that I like, demographics.
Yeah.
And I think it's a useful lens, or perhaps a macro layer through which to look. And I know you use it that way. Why are demographics important, not just for understanding Japan, but understanding the rest of Asia?
Yeah, so I think uniqueness of Asia is really growth and demographics. I started with the economy and growth. Apollo started the Asia footprint 20 years ago. Back then, Asia GDP was a little over 25% of the globe, and Japan was the only country out of the top 5. Last year, Asia economy grown to 40% of the globe, and 3 countries out of top 5 are Asian countries, which is China, India, and Japan.
Mm-hmm.
So economy is growing fast. That means corporate finance needs to support the growth of the economy is growing very rapidly. So that's number one. Number 2 is demographics. Asia society is aging.
I mean, look at what's going on here. This chart shows very clearly that Asian economies are in the wrong quadrant, right?
Yeah.
You know, when it comes to birth rates.
Yes. So society is aging, and as of today, number of retirees in the region is a little bit above 700 million. And it's going to be 1.3 billion in 25 years. So it's going to be double. So there's a strong need for retirees to invest in safe yield assets to prepare for their retired life. So Apollo's strategy is really rapid corporate finance needs in Asia, and also there is a demand for investment from retirees. Our strategy is to marry these two. Investment opportunity and investment opportunities, investing needs from the retirees.
I think there is, for good reason, a large number of people in the room who are curious about your thoughts on Japan specifically. So let's talk about that for a moment.
Sure.
For the first time in decades, right, Japan is experiencing inflation, and with it, important to note, a groundswell of reform.
Yes.
So we have JGBs recently ticked above 275 basis points, and everybody knows the Nikkei is on fire. We all want to know, how will these exciting and at the same time destabilizing trends take shape? As you see things, how is this reflation story going to play out?
So inflation suddenly started from 0 back a few years ago and to 3%. 0% and deflation went on for 25 years. That's very, very long time. But suddenly inflation becomes 3% and started to be stickier than people think. It's been 3% for a few years now. I think this fact changed all the mindset for both corporate and investors.
Mm-hmm.
So starting with the corporates, they need to have a higher ROE with the push from the government to corporate reform. They need to deliver higher wage growth for their employees, and they need to invest more to the future, which is incremental capex needs coming. So all the corporate mindset has shifted to defense, from defense to offense. That's a big change. And now the nominal growth of GDP jump up from 1% to 4%. On the investment side, this is an interesting dynamic as well, because there is so long deflation continues. Only product available for these retirees and investor was public equity or deposit. So public equity is obviously like a 20% volatility product, and bank deposit is 0% volatility, but 0 return. And now inflation is 3%. People cannot park the money in deposit, which is yielding 0 to 20 basis points. So there's a strong demand for investing into safe yield assets. So as a result, last year, government sold the retail JGB roughly $40 billion, which is a 5x compared to 3 years ago. So a lot of the investment demand is increasing, but product never being provided well.
To your point, investors got the memo. They understand that inflation is a long-term reality for Japan. Yet, they're largely reallocating to domestic assets.
Yes.
How do companies like yours, managers like Apollo, capitalize, right, on Japan's newfound appetite for risk when there are so many structural barriers to investing in global products, and in particular, less liquid global products?
So I think the appetite to invest globally is quite strong, actually, because people saw the low growth rate in Japan, and suddenly, even though suddenly it goes up to 4%, still people believe that the longer term, US economy is going to grow faster because of demographics, again. Japan right now loses roughly 50 basis points, 0.5% per annum of the population. Roughly 0.8% down with the natural born and natural death, and 0.3% recovered by immigration. That's going to be accelerated to minus 1% per annum, roughly 10 years from now. So if the number of people, just working population shrinking, it's not easy to sustain the same level of the growth as the growing population economy, which is the US. And also, I think the interesting point is the GPIF, which I used to manage the funds. The system is pay as you go. So everybody contribute to one pool and get paid from one pool. And a lot of retirees coming, and biggest population cohort is early 50s. I think it is 53 years old, where there's 2 million people per year. Now only 670,000 babies are born these days, so it's already 1/3. So much smaller number of people need to support the huge retirees, and a lot of 80% of the people rely on just the public pension fund system, which is pay as you go in declining population. So demand to invest outside the public pension system as a safety net is quite strong, because the long-term growth, perspective, people still believe the international growth could be higher than Japan. I think the investment needs for international assets is quite strong. That's where we can play.
What we're talking about, or what we've been talking about, is a phenomenon called Japanification. It happened to Japan.
Yeah.
People now talk about the Japanification of China.
Yes.
Is Japanification the right word to use for China?
I think there's a lot of analogies, and Japan hit the working population peak back in 1990, and China hit somewhere around 2014-15. So there's a 25 years gap, but I believe demographics driving the economy, and everybody know what happened after the working population hits. Both countries went to deflation, and real estate problems, non-performing loans, looks very similar to me. And also, Korea is a shrinking population as well. But the Korea path is slightly different, because size of the economy is slightly smaller than Japan and much smaller than China. And few number of very good companies can support the country's economy by export. So Japan and China has 10-20% of the export in terms of GDP. Korea has a 44%.
Japan's fatal mistake many decades ago was not recognizing bad loans.
Yep.
And it created an industry of zombie banks.
Yep.
Is China making the same mistake?
It's hard to say, as previous Chris said. I think China is trying to learn from Japan experience. unfortunately, Japan, again, the fastest, earliest country faces this demographic change. There's a lot of, test and experiment, but China learned a lot from Japan case, so I think they can do differently.
Are some of these outcomes inevitable, though, in the sense that, the demographics are what they are?
Yes.
And in the absence of massive immigration, some of, there's sort of a foretold future.
Yeah, I think there's a lot of synergy, the overlap between Japan and China for sure. But export can change the situation, as I said about Korea. So I think the China strategy for next 5 years really push the industry to grow faster, not the consumer and consumption. We'll see how that goes.
We will. I want to ask you a bit about India. There's a lot going on in India, world's largest country in terms of population, 1.4 billion people. And of course, in theory, as the fastest growing major economy in the world, it presents enormous opportunity for a firm like Apollo. What excites you about India? What gives you pause?
First, it's the fastest growing economy in Asia. Second, the size of the economy is now number 4 in the world. So there's a lot of demand for corporate finance, new capex investment. We're hearing billions of dollars worth of new capex needs.
That the banks can't satisfy.
Yeah, so there's a lot of private capital to play in the country, which we are paying a lot of attention to. But to be fair, still, I think capital market itself kind of in developing mode. So hopefully more infrastructure, regulations, all sorts of the infra for the capital markets to be built and improved in the future.
Let's return for a moment to demographics. Prime Minister Modi is fond of talking about India's massive population under the age of 65 as a demographic dividend.
Yeah.
Will the demographic dividend be a reality in the age of artificial intelligence? Because there's clearly the potential for AI to savage a huge swath of the Indian economy, the IT services sector, and of course the millions of people employed in the GCCs, the global capability centers that firms like Apollo or JP Morgan or Goldman Sachs or whomever has throughout India.
Sure, maybe we should ask that question to ChatGPT, but I think AI themes is probably too early to predict in the future. One thing, for sure is with this AI disruption, especially in India, the capex needs to build a data center, energy plant, all sorts of related, capex needs is increasing very, very fast. So as you said, local banks started to be capped on the exposure to different projects, and there's a huge room for private capital to play. So I think these AI disruptions create more capex needs for us, but it's very, very hard to predict the future.
When you ran GPIF, you had a principal decision-making role in shaping the future for generations of Japanese retirees. A very prestigious and consequential role. How do you see yourself making a difference now that you're working at Apollo?
So I think I'm kind of unique because we talked about the demographics. The experience of me working in the pension funds, understand the retirement service ecosystem in the country is very, very helpful. Apollo is the biggest retirement service provider in US. So there's a huge room for Asia countries to build the retirement service system, especially in Japan. So understanding of all the retirement ecosystem in each country, especially in Japan, which, as I said, pay as you go in declining population, there's a room for us to provide interesting service for the retirees.
Ueda-san, a pleasure speaking with you. Ladies and gentlemen, a round of applause, please.
Thank you. Thank you. Thank you. Thank you. Thank you. Thank
you. Please welcome to the stage Bloomberg's Zachary White.
Good morning, Hong Kong. It's truly an honor to be back in the city that, quite frankly, makes New York City that never sleeps reputation seem like a light nap. My name is Zachary White. I'm a product manager in our Bloomberg office as CTO, where I lead the go-to-market strategy for our generative AI solutions. Today, I'm excited to give you an update and a live look at our latest solution, ASPI by Bloomberg AI, and show you how it's designed to fundamentally augment your terminal experience. At Bloomberg, we've been offering comprehensive and powerful financial data in the industry for over 40 years. It's unmatched in both breadth and depth. For our customers, the challenge was never lack of information. It was being able to find what they needed quickly and intuitively. With ASPI, we're fundamentally redefining how customers discover Bloomberg's data. There's no more hunting around for answers. Instead, customers can find exactly what they need with our new conversational AI interface and agentic workflow solutions. Unlike general-purpose LLMs in the market, ASPI operates through a coordinated network of AI agents that work in parallel to analyze Bloomberg's extensive data and content libraries. These agents are simultaneously drawing from Bloomberg's premium content ecosystem to provide coverage across all asset classes, and it supports a wide range of research and analytical use cases. This includes hundreds of millions of company documents, Bloomberg News coverage, including 5,000 original stories, and more than 1.1 curated news items daily from our partners, independent research from over 1,200 sell-side brokers and expert network providers, in addition to research from our own teams, including Bloomberg Intelligence, BDEF, and Bloomberg Economics, and access to Bloomberg structured data and premium libraries like our alternative data set, ALTI. Now, I spent this year crisscrossing the globe as part of the ASPI rollout and moving between financial markets. In addition to having to pick up some tricks for how to deal with jet lag, I've also had to pick up some tricks on how to catch up with markets quickly in order to prep for client meetings. This is where ASPI has been a key tool. Given we are welcoming Bonnie Chan, the CEO of the Hong Kong Stock Exchange, on stage next for a special fireside chat, I thought we would look at the Hong Kong IPO market and its recent resurgence over the past 12 to 18 months to see ASPI in action. With this simple prompt, ASPI activates its structured market data and cross-document synthesis. This is helping to bridge the gap between high-level journalism and granular financial research. With that simple prompt, ASPI has generated me a Hong Kong IPO market resurgence narrative, inclusive of key metrics, market movers, success stories, cautionary tales, and a look at what's ahead. Every conclusion here is verifiable. ASPI will ground every response with a transparent attribution that will take you directly into the passage within the source document. This is helping you to independently verify the validity of the answer and build trust in the outcome. You have the option to engage directly with the author via our instant Bloomberg IB chat system, as well as email. In this scenario, I can see that Charney Wong on our BI team is online. So if I have any questions, I can go ahead and send her an IB chat. If I want to do some additional reading, I can go ahead and open up the original document as well in our artifact pane tool. Now, as part of this process, I've discovered that the Chinese automotive industry, with companies like Chery and Series, have helped to lead to this market success. Instead of thinking through a new prompt, I'm going to go ahead and open up our new ASPI workflow template library. These activities, like performing a company deep dive analysis or creating an industry overview, are manually intensive. It can mean going to 15 or more various sources to collate information to generate the report. We built ASPI workflows to eliminate this friction. It's a new capability that will allow you to transform ASPI from a discovery tool into an agentic workflow solution. Thank you for your time today. I encourage you to go outside where you have an ASPI demo station set up. I'll be there throughout the day to take questions, run through some additional use cases, and talk a little bit about our future roadmap. Thank you so much.
There is now a resounding belief that China is more than investable.
Please welcome to the stage Bonnie Chan, CEO of Hong Kong Exchanges and Clearing, for a conversation with Bloomberg's David Ingles.
Thank you, Bonnie. Thank you so much
David.
for taking the time. I was thinking of a way to set this up, but perfect segue from talking.
He said, ask B. I'm Bonnie.
Yeah, well, that's
Bonnie.
you're the perfect source really for all the data there. And okay, you probably are expecting a pipeline question. Have you ever done an interview where you haven't gotten a pipeline question?
I'm trying very hard to steer people away from asking that first inevitable question. But
right.
Please.
Yeah, now I'm caught. Well, the FS, the financial secretary, earlier said, well, two things. One is 400 plus companies have filed. Yes. That's accurate?
Accurate.
Okay. And that this year will, of course, be better than last year. Mm-hmm. I assume that's also accurate. Accurate in,
okay.
in what sense?
Well, let's talk about the pipeline. And instead of just focusing on numbers, let's put things in context. So last year, I think by now is a well-recited fact, we completed IPOs for 119 issuers and raising a total of $37.5 billion. So we are now in early June. We have already completed 66 IPOs, and the fundraise through IPOs to date is approximately $21 billion. So I think we're on good track. But like I said, let's focus not just on the numbers. I think what is very interesting to me with this pipeline, it's the composition, okay? And let me call out maybe a few themes. So broadly speaking, I see 4 emerging themes. First of all, it's definitely tech, okay? It remains I would say a very good portion of the pipeline. But within even the tech space, it's quite diverse. So obviously we have our flagship chapter 18A, which is pre-revenue biotechnology company that's still showing very strongly in the pipeline. We also have 18C, which is specialist technology, and that will cover AI. But I think even within the AI bucket, it's really the full value chain. So from chips to compute to large language models to applications to even, if you extend it further out, people talk about, energy, right? Which is very, very
That's important. That's a bottleneck too.
Yeah. And so, you really see a proliferation of all these issuers in all the different segments within the AI bucket broadly. That's theme number 1. Theme number 2, I'm seeing a return of mineral companies in my pipeline. And that's very interesting. I think it's, broadly speaking, the mineral space is getting back into the right cycle. I think that has a lot to do with just how investors are diversifying. We saw the movements in metal prices last year, for example, right, from gold to silver to copper to anything which goes into EV batteries, for example.
Real world assets.
Yeah, so I'm seeing a pretty strong return of mining companies in the pipeline. The third one is A&H. That continues to be a trend. And I'm talking about companies which are listed on the Chinese mainland exchange coming to Hong Kong for another listing. And a lot of these issuers are really doing that because they want an offshore fundraising platform to support their internationalization journey. And I think that is now a tried and tested route, which has become very popular. The fourth theme is something I really like to share. So people always say, hey, Bonnie, your exchange is too concentrated on Chinese businesses. Well, I know that we have historically been a very popular platform for Chinese-based companies to list. But when I did a double click on the 120 companies which listed on my exchange last year, what I found is very interesting. About half of them actually have revenue, more than half of their revenue generated from outside of China. So they are in fact already very international. I call them China MNCs these days. I also now begin to meet a lot of companies which are what I call born global. So on the face, you'll call them Chinese company, but if you really look into it, it's very international. And that's a new breed coming out, which I'm very excited about.
Talk to us about, that's a good paradigm shift, looking at the going abroad theme, going global theme of Chinese companies, China multinationals. You buy the S&P 500, you're not just buying U.S. companies, right? These are companies that do business around the world. How much more momentum do you see? And I imagine, is that in the A&H segment that you see that? Not just? But how much momentum do you see that as a pillar this year?
I think it's going to continue on a growing track. It's inevitable in a way, right? So let me maybe, everyone talks about the SpaceX IPO.
Right.
For example.
I didn't bring it up, but okay.
Oh, yeah, I'll bring it up. So it's obviously a very exciting and interesting deal, but a lot of people are also now looking into the supply chain behind SpaceX. Sure. And if you really peel the onion and look into it, I'm quite sure that you'll start seeing a lot of companies which may be what you generally looked at as Chinese companies. So what I'm trying to say is actually the global economy is still very interwoven, and the Chinese supply chain, really have a very broad coverage, and therefore, to your question, it's not confined to an A&H company. Like I said, you now will be able to pick up a lot of born global companies, which from the day they are established, is already quite global.
So safe to say we'll top last year's number, whether that's volume or actual money raised? Is that safe to assume, direction of travel-wise?
Yeah, well, let me say this.
Yeah,
usually, the second half is always sort of more active than the first half of the year. So I gave the number for the first half already. I keep my fingers crossed.
It doesn't seem like momentum has changed from last year. But on the surface, we showed you some headlines earlier. There have been some changes, whether or not it's this focus from quantity to quality. In what ways have things changed?
A lot of ways. But one thing that I find very gratifying is when I go abroad, and I just got back from Central Asia, I found that my engagement with both issuers and I think more importantly with investors a lot more interesting. I feel that global investors have now really turned their focus back to this part of the world. And 2 years ago, I probably will still be trying my very best to debate whether, or persuade global investors about the investability of China. Now, I think the assumption is it's very investable, but how should we do it and when should we do it? So I found that the conversation to be a lot more informed, more interesting. That to me is a very big and positive change.
How do we need to interpret the recent news of tighter oversight into cross-border investments?
Okay, so you're probably referring to the announcement made end of May, 22nd. Now, we took note of that, and basically it's targeting illegal cross-border investment. But the announcement also made a point to emphasize that the legal official channels are fine, right? Such as the Stock Connect, which obviously have been in place since 2014. And so, to me, Hong Kong as a market, obviously we want good, strong activity, but we also want to put an emphasis on compliant behavior and activities, right? So to me, I feel that it will probably, it's always good to tackle non-compliant behavior, but the fact that we can offer investors with a compliant and very efficient channel for them to do these cross-border investment, I think is probably going to position us very well.
Okay, so no issue that you foresee in the liquidity front being able to...
Let me give you the numbers. I always like to speak with facts. So since the end of May, if you look at volumes, let's focus on, southbound, northbound. I mean, everything has stayed pretty much, the same. In fact, May has been a particularly strong month for us. Last year, for example, southbound ADT for the year is at 121 billion Hong Kong dollars. It's improved about 14% year to date. Northbound has been very, very strong. So northbound last year was about 212 billion RMB. This is ADT, and now it's edging closer to 380 on some occasional days, touching 400, right? And what that is telling me is, while I know, right, a lot of people is under the impression that, the Hong Kong market has done well because you have all these southbound flow. Yes, factually correct, but I put more attention on the fact that the rest of the world seems to be more interested to trade in Hong Kong, first of all, but also through Hong Kong into the Asia.
Into China, the northbound connect.
Yeah.
Let's talk about the product. You guys are getting into the index business.
Yes.
Okay, so what does that mean and how are you doing it? And how does that show up in our world?
Okay, so yes, we launched our HKEX Tech 100 Index in December last year. And why are we doing it? First of all, I think we always want to venture into what we call adjacent business, which plays to the advantage of our strong core businesses. And we know investors, a lot of them needs benchmarks, to track.
But there's so many benchmarks already.
Yeah, okay, so why do we start with Tech 100, right? If we look at what is available today, we saw sort of a space, a white space that should be filled, which is an index which tracks a broader universe of technology companies. And by the way, tech companies, the definition has expanded quite significantly over the years. And so our Tech 100 actually also covers 18A and C, which other indices to date might not have. And the idea is that, we provide that, and hopefully that will give, or that will be a more representative, of what makes up our market, closer to the investor demand. And that's obviously the first step. The next thing that we should expect is obviously products, which will be offered on the back of these indices. And we're not going to stop with one. In fact, we also have, in the past few months, launched co-branded indices with other regional exchanges. So with Bursa Malaysia, we had now a co-branded large cap index, and it's it's constructed in a way where 60% are Hong Kong listed shares underlying, and the other 40% is Malaysian listed companies. And we will continue to stay close with the investors, and the idea is really to help them or to provide them with the tools so that they can in turn come up with products or trading strategies.
You mentioned one of the things that people constantly talk about is your reliance on China, but you've been traveling. You mentioned you're in Central Asia, you talked about Malaysia. What's the strategy there? Why are you going out to, and you recently had a big conference here as well of, I think, ASEAN and Oceania exchanges. So what's the thinking there, and how does that improve the product?
Well, I was listening to the previous speaker, Ueda-san, and I think he puts it very well. Asia, the Asian region is getting a lot more interesting, and in fact, accounts for 40% of the world's population or growth, and that there are so many opportunities that we as an international financial center should really position ourselves to capture. With Asia, I also feel that Hong Kong is now emerging as a very good capital raising platform for a lot of regional companies. Many companies are already listed in their home market, but they might have already outgrown their home market, right? So with the need to continuously raise funds, there is definitely a demand for tapping a deeper market, which Hong Kong is. And therefore, to me, it's always going to be two pools of participants that I look at and I focus on. On the one hand, issuers, on the other hand, investors. Right. And it should apply not only in Hong Kong, in the Chinese mainland, it should be regional and global.
Should we expect more Central Asian and Southeast Asian names to list on your platform? I mean, you can mention names if you want to, but...
Well, there was already one Central Asia company which came to list on our exchange last year. I do hope that there will be more, so watch the space.
Okay, that's all we have time for. Thank you so much.
Thank you.
It went through very, very quickly. Thank you guys so much. Bonnie Chandler, round of
applause.
Established in 2001, eFund is a leading comprehensive fund manager in China with over RMB 4 trillion under management. It offers investment solutions to onshore and offshore clients, helping clients achieve long-term sustainable investment performances. eFund's clients include both individuals and institutions. Long-term oriented, we have always been focusing on the investment management business since, and believe in the power of in-depth research and time in investing.
Please welcome to the stage Jeff Lee, Chief Investment Officer, Global Equity at eFund Hong Kong.
Global investors have a long-held narrative for China. It's the world's factory with a vast domestic market and an economy powered by property, infrastructure, and debt. However, things are changing. China is undergoing a structural transformation, and that transformation will bring a very different set of investment opportunities compared to the last. Let me highlight 3 shifts that matter. The first shift is from cost leadership to technology leadership. For much of the last 40 years, China's advantages has been straightforward. Lower cost. Today, China's advantage is increasingly innovation-driven. The world's second-largest economy has become the world's largest engineering ecosystem. Its strength is no longer low-cost labor. Its strength is the ability to innovate, commercialize, and scale at extraordinary speed. Look at industries like electric vehicle, robotics, biotechnology, batteries, and of course, most recently, artificial intelligence. The list could go on. In these industries, Chinese companies are no longer the followers. They are, in many cases, the global leader. And that brings me to the second shift, from localization to globalization. Historically, a Chinese company can become a giant simply by winning at home. Today, the best companies in China build global businesses from day one. They manufacture in Europe, they invest in Southeast Asia, they hire local talent in Latin America. Chinese companies like online platforms, social media, gaming companies, e-commerce are gaining significant tractions outside of China. We're also seeing Chinese consumer brands are building fan base all over the world. Now, if you look closely, the drive for globalization is really everywhere across all industries. And the implication for us is straightforward. When you buy a Chinese company, you're no longer simply buying the growth in China. You're buying a global enterprise that happened to be headquartered in China. The third shift is from growth at all cost to growth with discipline. The old economic model brought significant, impressive growth, but it also created excess, leverage, overcapacity, and lots of environmental costs. Today, China's focus is more on the quality of growth rather than the quantity of growth. And that means greener growth. China is building green energy at a scale, larger scale than the rest of the world combined. Carbon emission is now a core local government KPI. Disciplined growth also means better capital allocation. Across many industries, including the state-owned enterprises, we're seeing increasing focuses on cash generation, profitability, shareholder returns, and return on investment. In other words, China's growth is becoming more sustainable, both financially and environmentally. So what does all these mean for global investors like us? It means the old narrative for China is behind us. The future, the next phase for China is driven by something very different from the past. Technology, innovation, globalization, and sustainability. And the investment opportunity is no longer simply finding beta in China's growth. The opportunity is in identifying alpha generation in companies that's shaping China's ongoing transformation. Companies that are technology leaders, global champions, and disciplined capital allocators. Thank you very much.
Please welcome to the stage Winston Cheng, Senior Vice President and Chief Financial Officer at Lenovo, for a conversation with Bloomberg's Sang-Mi Cha.
Okay, Winston, so we have to start with the stock price, right? I mean, I've been looking at your stock for a while. Despite the sell-off and tech sell-off that we have been seeing, it's up 160% so far this year. It's a down day today. When you look at the chart, how much of this is real and how much of it is momentum driven?
Yeah, no, I think for our stock, it's really being recognized for our latest earnings announcement, which you see is unprecedented in terms of the re-rating of our stock. And that's supported by all the analysts' re-rating of the stock as well. So the stock price, in terms of the target price, went from the high single digits into now as high as $40 a share. So, triple digit in terms of increases in terms of that target price recommendation. And that's largely driven by the financials. In the fourth quarter, we announced adjusted net income of 101% year-on-year growth. And so I think from that perspective, we feel very comfortable in terms of the trajectory we have, especially as it relates to the fact that we have now much more diversified business from a PC player to now really an AI infrastructure player as it relates to our server business, which we had acquired from IBM back in 2015. And it's a very much of a leading product in the high performance compute space, which if you think about IBM, they were the first to really run AI, Watson, and they were also a hardware company. So they developed a machine which really were made to compute AI. And so that's why Lenovo is actually it's the leading high performance compute company in the world. And really AI servers today is really a subsegment of HPC.
Yeah, and NVIDIA actually made a very big push to elbow out Intel and AMD's x86 dominance with its RTX Spark chip. How popular do you think these ARM-based chips would be for the PC market? And what do you think will happen to AMD and Intel?
Yeah, no, I think there's a lot of innovation happening in the chip space, in the GPU side, CPU side. And I think that demand really mirrors our product portfolio set. In terms of compute capabilities today, that's in the cloud, driven by hyperscalers' needs for AI training. And then I think as they get ready to set up their data centers for AI inferencing, that will go from GPU to CPUs. And of course, as we look at today, the cost of compute and token generation, eventually it will go on the edge. And so a lot of it, whether it's data privacy or cost concerns, you will want AI compute on your devices in a localized basis that's only privy to you. And so we have that product portfolio set and the plan for that compute. And I think you really see the steps of NVIDIA really going in that direction of our strategic positioning as well.
Can you tell us how much Lenovo's RTX Spark chip laptop would cost? I mean, the chatters I hear is between $3,000, $4,000. Yeah. Is there any chance that the starting price would be lower than that?
I think it's initially, as we understand it, it's a premium product. But I think, I think this is something that would be over time, I think, in terms of repositioning of an AI product going forward, right? So I think we have the core fundamental portfolio set in terms of the screen-based devices, whether it's from a PC to tablet to smartphone. We think that serves as a foundation to AI devices going forward. Of course, people are talking about AI glasses. There's a lot of different data collections on you today with the rings and other things. And so that would just serve as a portfolio set. But I think in the near term, as we think about the strategic positioning, there's still already a lot of AI native companies who want to partner with hardware companies or have higher hardware-centric people into their organizations to develop that integration. And so we already do that with AI companies, and we're doing that with our own agent in terms of an orchestration layer. And so I think that's really the mirror of a starting point of AI devices going forward in terms of the NVIDIA innovation that you're talking about.
Sounds very expensive. But you brought a laptop here with you.
Yes.
And of course, it's not the RTX Spark laptop, but it's a whole innovation that you've been showing me.
Yeah, it's. I think it was me running out of the home today to work, but this is our award-winning rollable. So if you are at home today, a lot of people are working from home, and instead of plugging into a screen, sometimes I don't want to be sitting in my home office. I want to be in my deck or on the roof doing my call, just to change the environment. So you can kind of have your Teams or Zoom here, and you can still have another file. So I think that additional space and portability is actually quite interesting.
Yeah. I was saying it would be very nice to show the terminal here to work, at home or at the airport. But why don't we talk about the global supply chain, right? All the companies have been saying that they're under pressure because of component shortage, and memory shortage is going to last all through 2027. Yeah. Are you going to keep raising prices, or are you going to sustain the prices so that it stays attractive for hyperscalers and for the PC offerings?
Yeah, what's underpinning the shortage today, and the shortage is not just in terms of components, right? I think it's the great demand. It's the AI infrastructure build is probably the greatest infrastructure build in the history of mankind, right? From the Industrial Revolution to the internet era as we're building, and I think we're really seeing a repeat of that, and we haven't seen that in terms of this type of acceleration in the dollar spent. And you're seeing that in equity markets today, companies raising money, and the dollars that they're raising is going to go back into AI infrastructure build. A lot of that will be going towards this area. So I think the prices of components will continue probably to stay elevated, but I think at this point, because there's demand driven, I think that economic, as you say, in terms of that, the healthy margin should be able to sustain. I think in the device side, it's a little bit unprecedented in terms of this rise. So I think on the lower end consumer device, that percentage price increase in terms of cost will be much higher. So I think that's one thing. But our enterprise business, which Lenovo is very strong in terms of the ThinkPad and other businesses, should be much more sustainable. I think from the perspective of the last 10 years in terms of the PC market, it's generally greater than 250 million sets a year because there's a natural need and demand for PC products, for productivity, for entertainment. A lot of people are watching, big screen, not on big screen TVs anymore, but they're watching it on their laptops. So I think from that perspective, it continues to be a very essential device, both for productivity, also for entertainment.
And how do you foresee the growth drivers for Lenovo change in this AI space over time in the mid to long term? Especially, tell us a little bit more about enterprise on-site and sovereign AI needs.
Yeah.
When it comes to sovereign AI, we haven't gone out there like very big yet. But for instance, Korea is very big on sovereign AI.
Yeah, that's a great question. I think from the growth perspective, the AI infrastructure build is going to be significant for many years to come. In terms of what we're witnessing in the last few years has been mostly for training. And I think that training demand will continue to be there. But we're starting to see spend for the inferencing, because as enterprises get ready, and even enterprises like a Lenovo, your data is scattered. So I think the ability to really run AI today, I think we're just starting to surface. We got to get the data ready. We got to get our processes ready. Then people will really then be able to leverage AI. And then from that perspective, the demand for inferencing will really accelerate. And you're starting to see that build out in terms of not just from US and China hyperscalers, but you're starting to see that from other very large countries and large economies as well. So as you say, South Korea. So I think the sovereign AI, in terms of that data sovereignty, will be very important in terms of sovereignty for country, sovereignty for people like ourselves, in terms of our proprietary business knowledge and data. We'll need to a certain extent train our AI within our environments. And I think that works for sovereign AI and for key enterprise AI as well. That needs to be on-prem, trained with your proprietary knowledge. And I think so that would drive a lot of the local investment. But in the short term, I think that investment will be more flexible because some companies may accelerate the path towards cloud in the near term. And that's why it's also driving, either way, it's driving the demand for AI infrastructure spend. But in the near term, because prices are so high, some people might let go of that opportunity and use cloud computing. But as prices come down, I think people long-term do need to build out their own infrastructure.
And speaking of prices, companies across all sectors are on a capital raising binge, right, to build out their AI infrastructure, their build out. Is Lenovo going to follow suit to compete through either debt or equity raise, or you don't have to?
Yeah, and I say the access today, AI, and I think it's access. The AI is really not artificial intelligence. It's access and innovation. The access is access to land. It's access to power. It's access to components. It's access to capital. So capital is just one component of that And you're seeing that with AI companies, right? With the IPOs that are coming, you see then Alphabet coming to the market ahead of these two to really get their share first. And of course, we see the SpaceX IPO this week as well. So I think from that perspective, I think overnight you also see Supermicro also raising. So I think there's a lot of capital demand for the space but that demand is underpinned by growth opportunities. So companies are not raising for the sake of raising. They're raising for clear use of proceeds and because there's clear business opportunities ahead of them. So I think if there are visible, clear, attractive business opportunities, we will probably need to fuel that growth with additional capital as well.
Okay, and other than the actual laptops or the space that you're looking at, of course, Lenovo also is one of the major approved OEMs to distribute H200 chips in China, right, from NVIDIA. How do you foresee this market? Do you have any shipment projections for this year, for instance?
Yeah. Our business, ISG, actually grew 37% year on year, but actually the real growth is actually much higher than that. Because in the fourth quarter of the prior year, we actually were, before regulations really came in, we were still doing some H20s in China while it's still very compliant. So I think that went away. So actual growth is much, much higher than the 37% that we see year-on-year growth in the last quarter. Should there be a regulatory path towards H200, I think there will be demand in the market. But right now, what we know is that clearly NVIDIA has applied for this license, and Lenovo is the OEM that is authorized to distribute. Yeah.
And staying on this topic a little bit, but as the US-China AI race intensifies, can Lenovo stay above the fray, or at one point do you have to pick a side?
You know, I think Lenovo is a global company in 180 markets. You know, our core technology, I think that the key to everything right now is understanding the regulations that exist in all the markets, right? I think the non-regulations, not just in terms of chips and other things, but it's really, you know, whether it's ESG related as well. I think that's also important. And that's why we built a factory and in partnership with PIF a lot in the Middle East, because to use the sustainable energy, right, in terms of doing this and really to have the hopes of supplying this and exporting out of the KSA in the future for ESG related matters as well. So I think from that perspective, really being compliant, being ahead, particularly in visionary, like a sustainability effort like this, I think it's important for us. Yeah.
And I don't want to take up your time for lunch, but are you not worried about the share price? Is it too hot right now? Or it's a down day today, but do you think this consolidation is rather healthy?
Well, I never really look at the day to day, because I think 180% of I work probably 18, 19 hours a day, right? I think about it. And so 180% of my efforts are towards creating value to our business and to shareholders. So I think as long as we're doing that and working hard and efficient, I think there's only one direction to that. You know, and clearly this time we're setting this in terms of post earnings. Our options are set at this $20+ level. So we'll be working hard to create additional value.
Great. Thank you so much for your time, Winston.
Thank you. Thank you.